वेलकम टू वीलर्न में आपका स्वागत है। The topic for discussion is mergers and acquisition, and we will be discussing accounting for amalgamation. Topics covered are introduction, definition of amalgamation, types of amalgamation, amalgamation in the nature of merger, amalgamation in the nature of purchase, methods of accounting for amalgamation, pooling of interest method and purchase method, purchase consideration, lump sum method, net sales method, net payment method, and intrinsic worth method. Treatment of reserves of amalgamation, treatment of goodwill arising on amalgamation, and treatment of share premium, goodwill, and other profits. In this particular unit, we will be studying accounting provision for the amalgamation. When we say amalgamation, it is basically means merging of two or more than two companies or organization for eliminating competition among them for growing in size to achieve the economies of scale. Amalgamation is a broader term which includes both the acquisitions and mergers. Acquisitions are basically when two companies buying out another, when one company is buying out the another company, and merger is uniting of two existing companies. The Institute of Chartered Accountant of India, in their Accounting Standard 14, they have also issued accounting for amalgamation. However, in the Companies Act, they have not very specifically defined the term amalgamation, but it is very important that the Accounting Standard 14, they must do away with the distinction between mergers and amalgamation. According to AS 14, merger is only one type of and therefore only a part of the amalgamation and not a discussed in totality. When we say types of amalgamation, there are two types of amalgamation. The first one is merger. As we have discussed, merger is a kind of an arrangement where the two existing companies, they unite together for a project in hand. When we talk about acquisition, acquisition is a scenario when one company, it buys out all the shares and properties of another company. When we discuss amalgamation in the nature of merger, so according to Accounting Standard 14 and Para 3E, an amalgamation which is in the nature of merger must satisfy the following condition. The first condition of amalgamation in nature of merger is that all the assets and liability of the transferor company, they become, after amalgamation has happened, the assets and liability of the transferee company. The second is the shareholders who are holding not less than 90% of the face value of the equity share of the transferor company. When we talk about transferor company, they are the companies other than the equity shares already held therein. Immediately before the amalgamation by the transferee company or its subsidiary or their nominees, they become equity shareholder of the transferee company by virtue of amalgamation. The third is the business of the transferor company is intended to be carried on after the amalgamation by the transferee company. The fourth one is the consideration for the amalgamation received by those equity shareholders of the transferor company who agreed to become equity shareholders of the transferee company is discharged by the transferee company wholly by the issue of equity share in the transferee company, except that the cash may be paid in respect of any fractional issues or shares. The last is no adjustment is intended to be made to the book values of the assets and liabilities of the transferor company when they are incorporated in the financial statements of the transferee company, except to ensure uniformity of accounting policies. When we discuss about amalgamation in the nature of purchase, so we are basically discussing that which one does not satisfy one or more of the conditions which are specified. So thus fulfillment of all the 5 conditions which we have just discussed is very essential to call it an amalgamation or merger. Even if one condition is not satisfied, the amalgamation becomes the nature of purchase. There are certain conditions for amalgamation in the nature of merger which are identical with the conditions which are laid down in Income Tax Act of 1961. The 3 important features of amalgamation in the nature of mergers are: first, shareholder holding majority of the equity share of the transferor company, which is at least 90% of the transferor company, would become equity shareholder of the transferee company. This implies that in case of merger, there will be exchange of shares between transferor and transferee company. Such exchange would be determined by shareholder value of respective company. The second is the business of transferor company must be continued by the transferee company. In case of merger, the transferee company after amalgamation cannot ignore the business interest of the erstwhile transferor company. The third is assets and liabilities of the transferor company will be incorporated in the financial statements of the transferee company at book values. So adjustment to book values will be made only if the companies in question follow different accounting policies. If shareholders of the transferor company are not given share of transferee company in exchange and discharged by way of cash payment, and or if the business of the transferor company is not continued by the transferee, such an amalgamation will be considered as purchase. Methods of accounting for amalgamation. So, as per Accounting Standard 14, there are 2 methods of accounting for amalgamation. The first one is pooling of interest methods. So, It is also applicable in case of amalgamation in the nature of merger. The second is purchase method. It is applicable in case of purchase, amalgamation which are in the nature of purchase. When we talk of pooling of interest method, it is basically referring to uniting of interest of two companies who are operating in the same line of business. They can come together to have greater market share. So independently these two companies may be smaller, but when they unite together they may become big companies who are capable of becoming the market leader. So the pooling of interest method, it involves various steps. The first step is whatsoever the assets, whatsoever the liabilities and reserve of the transferor company, it must be recorded and taken care of by the transferee company at the time of carrying out the existing amount, unless there are adjustment if necessary is due to different accounting policies. The second method is the balance of profit and loss account of the transferor company should be aggregated with the corresponding balance of the transferring company. The third is the difference between the amount recorded as purchase consideration and the amount of share capital of the transferor company should be adjusted in the reserves. When we talk about purchase methods, it is basically applied for the amalgamation which appear to be in the nature of purchase. Since most of the amalgamation they are in the nature of purchase, and understanding of the purchase method becomes very essential. So there are various steps which are involved in purchase method. The first step states that the assets and liabilities of the transferor company, they should be incorporated at their existing carrying amount, or for the consideration should be allocated to the individual identifiable assets and liabilities on the basis of their fair value at the date of amalgamation. The second is the reserves of the transferor company. Other than the statutory reserves, they must also be incorporated in the financial statement of the transferee company. The third is the statutory reserves of the transferor company should be incorporated in the financial statement of the transferee company and maintained for a specified period. Such statutory reserve should be matched by another account. These accounts could be of the nature of amalgamation adjustment account in the balance sheet. So these amalgamation adjustment account should be disclosed as a part of miscellaneous expenditure in the balance sheet. When the identity of the statutory reserve is no longer required to be maintained, both the reserves and the aforesaid account should be eliminated from the balance sheet. Another is any excess of the amount of consideration over the value of the net assets acquired should be recognized in the financial statement of the transferee company as a goodwill which is arising out of amalgamation. If that amount of consideration is lower than the value of the net assets required, the difference should be treated as capital reserve. The last is the goodwill arising on amalgamation should be written off over a period of 5 years, which which in a longer period may be considered if deemed necessary. When we talk about purchase consideration basically implies a value which is agreed upon for the net assets taken over. So the amount here is dependent on the terms of the contract between the transferor and the transferee company. According to AS 14, it defines the term consideration as the aggregate of the share and other securities which are issued and the payment made in the form of cash or other assets by the transferee company to the shareholder of the transferor company. Here the consideration for amalgamation may consist of share and other securities, cash and other assets, and the amount of consideration depends upon the fair value of its element. In such a case of issue of security, the value fixed by the statutory authorities may be taken to be the fair value. In case of any other kind of asset, the fair value may be determined by reference to the market value of the assets given up to. There are different methods which are followed for calculation of consideration. The first one is the lump sum method. Lump sum is the very simplest method, and here the consideration is stated as a lump sum. Say for example, it may be stated that A Limited takes over the business of B Limited for rupees 20 lakh. Here the sum of rupees 20 lakh is considered as a lump sum consideration. When we talk about net assets method, so net asset method basically here the consideration is computed by adding the agreed value of the assets taken over by the transferee company and deducting therefrom the agreed value of the liabilities taken over by the transferee company. So the agreed value is the amount at which the transferor company has agreed to sell and the transferee company, it has agreed to take over a particular asset or a liability. When we talk about net payment method, so it is a method wherein consideration is computed by adding all the cash paids, by adding the agreed value of the assets which are given and the agreed value of the securities which are allotted to them by the transferee company to the transferor company in discharge of consideration. When we talk about intrinsic method or intrinsic worth method, here consideration is calculated on the basis of agreed value of shares of the transferor company. Shares are ownership securities, so if the transferee company pays for all the shares of the transferor company, it can be said to have paid for the entire business of the transferor company. Now there is some treatment of reserves of amalgamation. So if the amalgamation is of the nature of merger, the identity of the reserve is preserved and they appear in the financial statement of the transferee company in the same form in which they appeared in the financial statement of the transferor company. Thus, for example, if the general reserve of a transferor company becomes the general reserve of the transferee company, the capital reserve of the transferor becomes the capital reserves of the transferee company. Now, how goodwill would be treated arising out of amalgamation? Goodwill arising in amalgamation, they represent a payment made in anticipation of future income, and it is appropriate to treat it as an asset to be amortized to income on a systematic basis over its useful life. So due to the nature of goodwill, it is frequently very difficult to estimate its useful life with reasonable certainty. Such estimation is therefore made on a prudent basis. So accordingly, it is considered appropriate to amortize goodwill over a period which is not exceeding 5 years unless a somewhat longer period can be justified. There are factors which may be considered in estimating the useful life of a goodwill which is arising out of amalgamation. The first is the foreseeable life of the business or industry. The second is the effect of product obsolescence, changes in demand and other economic factor. The third is the service life expectancies of key individuals or group of employees. The fourth is expected actions of competitors or potential competitors, and the last is the legal, regulatory or contractual provisions affecting the useful life. There are treatment of share premiums, goodwill and other profits. So the basic difference between net payment method and net asset method is that the net payment method, goodwill which is of capital reserved to the purchasing company, is the difference between the purchase consideration which is agreed to be paid and the value of the net assets, which are tangible assets taken over, while in the later the value of the good is first determined and agreed between the companies. Another feature which is to be noted in the reserve and surplus head of any organization is that there are general reserves, there are share premiums, that could be development allowance reserve and profit and loss account. Two exercises is enumerate various purchase consideration and what are the different types of amalgamation. Thank you and have a nice day. Keep learning and relearning.